Joining us now to take a deeper look at Broadcom, we've got Tom White, senior options contributor and co-host of Fast Market. All right, I know you got the chart first before your example trade, Tom. So let's talk about some of the trends you're seeing in the 3-year chart.
Yeah. That's, I think, you gave all the downbeat news on what's been happening with AVGO, Diane. So I'm going to give you a 3-year chart to take a look at, to give you some context, because sometimes when you look at a 1-year chart, it can look really ugly. I'm going to give you a 3-year chart because this stock's up over 220% over the last 3 years. We were about 57 bucks 3 years ago on today's date. And now we're back above, the 180 level at this point. So still great gains if you've been an investor in this stock. So I wanted to kind of broaden out the picture for you and give you a little bit of semblance. Maybe this pullback's warranted at this point. But now we'll go a little bit, closer in context and do a look at a 1-year, 1-day chart here that has some key levels, I think, that people should be focused on going into earnings. We've got a 1-year chart, 1 day. This line right here, about just above 179, is going to be the 200-day moving average, simple moving average. That's going to be a key level of support, about 179.70 on that level. That's one you should be keyed on. That 50-day moving average up at 224. So we're far below those measures. And if you look at the pullback in some of the competitors within this space, whether it's NVIDIA, some other chip makers and chip designers in this space, we've seen massive drawdowns. Now we're in bear market territory on the pullbacks we've seen. You see the volume node here, another key area of support, around 172. That's that key area of support as far as volume levels too. So keep that in mind. And then on the lower part of this chart, we've got the RSI. Now, it settled yesterday at about the 35 level. Anything on the relative strength index below 30 is considered oversold on a technical basis. Now, with the stock down in the pre-market, with the market getting hit, it's going to probably open up around that 30 level on RSI. So that's also maybe a key area of support if it's oversold at this point. Now, we've got earnings coming up. So what are we going to do? We're going to look at an example trade in here, Diane, next.
Yep. All right, so take it away with your example trade, Tom, for Broadcom ahead of earnings.
Yeah, so I think the key thing going into this earnings report, the option market's pricing in just over a $15 move either way in the stock. That's about 8% in AVGO. Now, I'm going to take a look at implied volatility levels because there's big dispersions. There's event risk, right, going into this report tonight after the close. And I want to look at a strategy that takes advantage of it. Now, if you think this key level of the 200-day moving average around 179.70 is going to be an area of support, here's a strategy that takes advantage of maybe a rebound in the stock. You don't need a massive rebound, but maybe the stock goes up post-earnings. This takes advantage of it. So I looked at a bullish call diagonal here, where I'm going to go out to the March 21st monthly cycle. That's just over 2 weeks to expiration. I'm going to buy the at-the-money call, the 180 strike call. And in the near term, March 7th weekly options that expire tomorrow at the close, I'm going to sell the 200 strike call. So a bullish $20 wide call diagonal that's 2 weeks in duration. I'm going to pay roughly, if we open up, the stock opens up here around 183, the price is going to be about a $12 debit. There's your risk, $1,200 per spread on a $20 wide bullish call diagonal. Your break even going to be about 185. So you want the stock above 185 over the next 2 weeks for this to be profitable. Now, why am I paying only $12 debit for a $20 wide bullish call diagonal? Well, it's called volatility dispersion on this. So in that March 21st monthly option where I'm buying the 180 strike call, I've got a IV percentile of about 76. So low implied volatility. In the near term March 7th options where I'm selling that 200 strike call, I'm selling about 177% implied volatility. So that vol dispersion creates that lower price point. But this takes advantage of a move higher if you think the stock's going to rebound and you're taking advantage of that vol dispersion.
All right, that's an example trade for Broadcom ahead of its earnings. On another note, love the blazer suit jacket, Tom.